welcome to Crack the Code, a show that helps you become a smart and informed investor. I'm Sumaira Abdi. This week, the spotlight is on the infrastructure sector, a major driving force of the Indian economy.
The infrastructure sector covers a wide gamut of industries. It includes electricity, public utilities, telecommunications, roads, airports, railways and water systems. Increased spending in this sector serves as a multiplier effect on the economy as it necessitates industrial growth and manufacturing. This in turn boosts aggregate demand by improving living conditions. India's 2016-2017 Union Budget provides a significant outlay for infrastructure expenditure. This spending is seen as a key component of the government's plans to boost the country's growth levels to 7 to 9%. The allocation of $32.70 billion or 2.21 lakh crore rupees to infrastructure and a newly liberalized foreign direct investment policy further underlines the government's commitment in this regard.
Well, to discuss this and more, I have with me Mridul Mehta of ICICI Securities and Abhimanyu Sofat of IIFL Markets. Gentlemen, thanks very much for being a part of this show. The infra sector is in focus, but forever the infra sector, the stocks have been underperformers, right? One of the big reasons has been the high leverage that these companies have. So debt is one of the key triggers when an investor wants to look at anything from the infra sector. How should one actually be reading the debt to equity? How crucial is it for infra companies, and how does an investor actually look at investing with this the big size of debt that these companies actually have?
For infrastructure, there are two sorts of companies which are there, and there could be a combination of the two. One is the companies which are into pure construction,
right,
and others which are there as BOT projects and they own the projects. And a lot of companies are actually combination of the two, and they are doing construction for their own projects as well as third party. The leverage which is required for both these types of companies is slightly different. So you would have a lower leverage which would sustain a pure EPC company, say 1.5 to 2 times, not beyond that. But most of the BOT projects have a little higher leverage of 2.5 up to say 3 times debt to equity levels. So you would have somewhere a blended between these numbers for a company which is of a mixture of EPC and the BOT. And those are the sort of sustainable debt levels that one should look for when evaluating companies in the sector.
Okay, so close to about 2:1.
On an average, if you look at a blended sort of this thing, yes.
Okay. Abhimanyu, how does one read the capital cycle and the requirements in companies like these?
So see, if you see the entire cycle, companies within the sector, most of them are around 3 to 4 times order book to sales. Right. So clearly we have seen over the past years, a lot of order book has been generated, but at the same time, the sales have not come. The main reason for that has been that the government is not making payments, interest cost has been too high. At the same time, since last 5 years, we've seen most of the BOT projects being the main kind of projects being there, revenue growth not being there, they have not been able to sustain only. So from a capital perspective, I think so the key element tomorrow is going to be how do you make a mixture of a BOT and an EPC, and then going forward take ahead whatever problems we have seen over last 5 years.
Okay, so in that case, one of the most crucial factors to check is also the revenue visibility for a company, and how many quarters hence should you be checking that for?
To check the revenue viability, one needs to also see how the product has been made. As of now, what happens in case of a BOT is because the IRR is expected to be higher relative to when you do an EPC kind of a business. So all the players went into this with more of hybrid models coming in, where 40% of the cost is taken care by the government and rest of the project goes on a IRR, though at a lower IRR. I think that those kind of projects will be more sustainable. One needs to look at more from a cash flow basis, how things are happening. I would say any company which has a visibility for next 2 years in terms of revenue is good enough to look at, as long as you are seeing a conversion of the order book to sales. That is a key element to look at, rather than just seeing the sales as standalone, or how much is the order book of a company.
Okay, fair point, because Mridul, I want to actually take off from this. We've seen a lot of companies being hit by execution problems, right? So they have the orders, but they're just not able to execute. Now, part of this also comes from the lack of funding available at times, right? But what does that mean as a trigger? Is it the time to then sell if you realize that there are execution problems in your particular stock?
So it really depends on what the reason for the execution issues. One could be the working capital issues, because there have been delays on receipt of payment for the orders already executed, whether it's from the government, private sector, wherever. And the second part is where the projects are stuck, you have taken debt and you are not able to execute because of the issue about say land availability or other related issues for execution of the project. So if that were to be the case, I don't think it's a trigger to sell a stock, but it really how sustainable is the balance sheet in terms of taking some delays, some amount of stress, because the sustainable order book is something which will keep the company going. If the margins for those projects have been bid at reasonable levels, and because of these delays the margins come down, that's okay. You don't have uniform margins in all the projects. As long as the margins, the projects were bid judiciously, and in spite of some of those delays, the projects on a standalone basis are still profitable for the company, I think that's absolutely fine.
Since you mentioned balance sheets, I'm going to jump to this question right now. Take a major like L&T or even BHEL for that matter. I mean, I have to admit that just going through their balance sheets or P&L is so taxing for a lay investor, right? Some of them, they're reinstated, right, the accounts. Sometimes just going through their various annexures is so troubling for someone who's not familiar with the entire infra sector. How does an investor actually look at their P&Ls?
So if you look at both the companies, say for example in case of BHEL, it is still simpler because they have the main BTG business and then they have an industrial business. So you can just look at the PE of the company and see what's happening. The main problem with BHEL was that it was a kind of a monopoly. You had competition, so margins came down, and that's why we've seen the stock not doing well. In case of L&T, it's been an issue of getting things which were not his core, whether it was something related to a metro project or those kind of things which happened going into Middle East, and there was a oil related issue. Typically what you need to do in these kind of businesses is measure the standalone business separately on a P kind of a multiple or EV EBITDA kind of a multiple, if you can segregate it properly, and then do a SOTP of various investments that they have done, and that is the best way to look at these kind of businesses.
Okay, and Mridul, taking off from there, the guidance that the managements give in their quarterly reports, are they set in stone for investors? I mean, should they fall short of that guidance or should they exceed that guidance? What does that mean for the stock?
See, I think the visibility for infrastructure, wherever the BOT projects is concerned, for a quarter is fairly good. Where it falls short is really how much, say, order book increase is going to be there, how much of execution and revenue they are going to get, and that's something which is not entirely under the control of the company. The order book, in a lot of cases, a couple of large orders can make the difference to the order book itself. How judicious is the company in terms of bidding for projects with what sort of margins? Building an order book beyond a point is not that difficult, but it's only difficult if you are actually bidding for the right sort of projects for the right sort of margins. So from that point of view, visibility, there is part of it which is under the control of the management, but a large part of it in infrastructure is really dependent on government policies.
policy environment is turning, right? Now we know that so far 70% of the stress in banking was actually from discoms as well as infra, right? We have seen some payments relief coming in from for infra companies. There have been some reforms made in the debt market as well to facilitate funding. Going forward, which are the stocks which are best capitalized to actually benefit from these? I mean, what are the kind of companies that an investor should be looking at positively in this light?
What we feel is that one should look at more companies which have a model which is low in terms of, asset quality. So one needs to look at stocks like, KNR, PNC, which are more of an EPC kind of a player who are focusing on the business with lesser amount of leverage. In relation to that, you have other players which are more on the BOT side, where there is no viability of, whether revenue will come or not. So we would always prefer a EPC kind of a player relative to a BOT player in the coming next 2 years.
Okay, fair enough actually, because for the road sector as well, things are turning around, right? Ordering has picked up. Even NHAI started releasing payments, right? So is this now the sector, the subsector from within the entire infra gamut to look at in the coming years? I mean, for a value investor who's looking at the next 10, 20 years, does it make sense to actually bet on stocks within the road sector, or is it going to be too dicey given the long-term horizon?
I would not generalize saying that all the road companies which have BOT projects are good, but a lot of them which have built a bouquet of projects which are fairly diversified are actually pretty good. So companies like IRB, which have actually diverse set of projects, or an Ashoka Buildcon, which has a diverse set of projects, or an ITNL, which again has so many operational projects, that provides a lot of flexibility for the company to do various things. So they have an option to actually sell off some of the projects and release capital to bid for new projects which will finance growth. They can there are companies which are like IRB, which are talking about doing an infrastructure investment trust, InvITs. So it does provide a lot of flexibility when you have a bouquet of projects to sell off some projects, release cash, release capital. You have invested in those projects. You can get new projects, get EPC business out of those new projects that you bid for. So, a mix of risk diversification out of these sort of projects gives a lot of flexibility to the balance sheet.
Okay, taking off from this, Abhimanyu, what are the triggers to actually enter a stock? I mean, for someone who's looking to actually get in for the long term, should it be perhaps on dips? What are the reasons that dips in certain stocks are investment worthy opportunities? As well, what are the triggers to actually exit this stock? I mean, when is the deal done for infra companies?
So I think key thing that one needs to look in infra companies is clearly working capital. Most of the companies have an order book, they have certain amount of visibility over next 2 to 3 years. So what is happening on the working capital side and how the order book is getting converted into sales, I think that is the most critical thing that one needs to look at, in addition to obviously at what margin those projects have been bidded and what is the current situation with those projects. I would go by that to be the single key factor. And if you see a deterioration in these kind of metrics, that is the time to get out of those stocks.
Okay, so let's also look at forward triggers, right, for this stock. I mean, say for something like power. Now, capex cycle has been such a big problem for power. How do you look at stocks in this space now? I mean, what are the kind of companies that an investor can even look at? Should they be looking at power at all for the next 10 years?
So power is really the driver for the economy. Any new industry would require power for its growth. Traditionally, India has been more of thermal power, but last couple of years, because of the government thrust, has seen a lot of thrust on the growth on the renewable side. So you have a lot of wind companies which have above a gigawatt of generating capacity. You have a lot of the solar companies which are coming. So in the times to come, you will see a definite shift of larger companies on the renewable side, and some of them over a period of time will get listed too. But from a thermal point of view, it is something which cannot be ignored. Renewable whether it be a solar or a wind, have their limitations in terms of seasonality, and therefore they can be an integral part of the overall power development scenario for the country. But you cannot move away from the fact that coal and thermal will remain the backbone. So from a long-term point of view, I don't see how you can ignore the Tata Powers and the JSW Energies or NTPC of the world, or Adani Power for that matter.
Yeah, so renewables gain is not really thermal's loss.
Absolutely not. It can't be.
Okay, so Abhimanyu, tell us in terms of stocks then. One, since renewables is not really thermal's loss, which are the stocks from both of these that are best placed to actually catapult an investor's portfolio over the next 10-20 years?
There are very few stocks on the renewable side. You have, Suzlon, Inox, or, if you go a little bit on the mid-cap side, then there is a Swect Energy. Very few stocks are there, and as such, in terms of a business model which is quite consistent over a period of time, none of them have been able to exhibit that, except for a little bit Inox, that you have a considerable profit growth and all. I would agree with him that stocks like Tata Power and all are something that one should watch out from the conventional sector perspective, which will continue to do well going forward as well.
Since you mentioned Suzlon, how do you read news that say Dilip Sangvi has picked up a large chunk in a company like Suzlon, which has had innumerable problems of late? Do we just trust a single big investor's jump into a company as trigger enough for a turnaround in that stock, or do you think an investor still needs to do their own research?
No, absolutely, one needs to do his own research, but yes, when you have somebody as competent as Dilip Sangvi invests in a stock like Suzlon, so you need to just see your investment thesis again, what could be the possible reason that he would have invested. So for me, something like a Suzlon, the first criteria is, when does it becomes cash flow positive? That was the first thing that people have been looking for last 1.5 years on the company, and obviously what will be the profit growth. So there are a lot of investors who are interested because it was a darling of the markets. But I think so, until and unless you see a consistent growth in numbers in the stock, getting to those previous levels will be a challenge for Suzlon.
Yeah, because barring this, one hasn't really read news of any big investor actually picking up large chunks within any of the infra space. Do you think that's about to change? Has the time come for infra stocks to be re-looked at or revisited from a new perspective?
Government, as you mentioned, NHAI having taken steps to release money, or the government having done the Uday scheme for power. So that has already yielded results, and infra stocks over the last 3 months or so have already moved up. So that's something which we've seen, I feel, the worst in the sector. The government has recognized the stress which those companies were facing. The banks, in a lot of cases, have restructured the debt. There was RBI coming on with their 525 schemes and for restructuring of those projects, recognizing that these were temporary dips. So I think the things are in place now for the stocks to do better. It's a question of some of them doing better than others because their balance sheet is in a better state than others which are still trying to repair the huge debt which they used to have in the balance sheet.
Yeah, well, this is after a long time that there's so much positivity on the infra sector all coming together. But where does that leave the matter of clearances then? Is that the only negative hurdle for this sector left?
I think so. Still there are challenges there in terms of raising of capital for sure. What we've also seen recently, a lot of asset reconstruction companies coming aboard to India, and that is one segment where one could see a lot of these players getting some kind of capital, especially within some specific projects. So yes, getting capital would be a challenge for the sector, in addition to getting clearance. So I think so those will continue to remain, will be the two main hurdles for the sector.
So infra itself has this larger umbrella where it covers things like aviation, airports, ports, telecom, so on and so forth, waterways. Anything from this larger umbrella that merits attention from the retail investor?
So some of these, the number of stocks available are limited. A large part of say the port sector is implemented by the government, and fewer listed private sector being there. But aviation is something that we have a few listed stocks. There's growth in aviation infrastructure through airports that the government is developing. That gives an option. Telecom is an active sector by itself, and there are various stocks available to invest there. These are growing sectors which give investors a lot of opportunities depending on the time when you select it.
One can clearly see port, for example, to be a very big opportunity. Already the major ports in India are at full utilization, and we've seen a significant growth in the smaller ports recently. So if we are able to have a decent strategy, I think so the sector is going to catapult significantly over a period of time. You have very few players who are there right now, but I think so there's a lot of interest considering the kind of coastline India has.
All right, so slowly but surely things are on the mend for infra, and the once forgotten sector perhaps is now finding interest once again. Gentlemen, thanks very much for your time, and thanks very much also for taking us through the nuances of the infra sector.
Thank you.
All right, so there you have it, expert advice on the key elements that you must consider while investing in the infrastructure space. That's all for now. Until next time, keep watching CNBC TV 18.